I look across my investing portfolio. I look at the four growth stocks I own, which is Salesforce, Google, Amazon, and Crocs. And then I look at my dividend growth portfolio, which has very defensive, high yield dividend growth companies like WP Carey, JP Morgan, Lockheed Martin, Pepsi, and so on. Many of these companies are constantly growing their revenue, growing their earnings over time, and investing in them will slowly over time make you more wealthy as an investor, as a shareholder of these wonderful, amazing, incredible assets that are cash flowing, profitable businesses that will overall grow your wealth over time. Now, something I see a lot of people invest in is bonds. And what you're looking at right here is the 10-year treasury, and right here you're looking at the 30-year treasury. Now, right now they generally sit just under 4%, roughly 3.75 between the two of them. And I want to talk about treasury bond ETFs. Specifically, we're going to be talking about two from iShares, which is the 7 to 10 and the 20 plus treasury bond ETF. And we're going to talk about how the growth prospects for these two investments over time look compared versus the traditional stock market. Because the thing that bonds have over these stocks is that they're very defensive. They don't fluctuate up and down in price like traditional stocks do because they're paid out at maturity, but they don't have the rapid level of revenue growth that many of these other cash flowing investments do. So we're going to talk long term how these defensive, profitable businesses will outperform or underperform many of the other bond ETFs that we're going to look at in this video. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up today using my special referral link, then you can receive $10 plus an additional 15 free stocks pending certain deposit requirements. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, so let's go ahead and start by looking at the treasury yield where we're at today. I mentioned this at the beginning of the video. If we look at the 10-year right now, it's currently at 3.69%. And if you look over the last year, let's pull up the candlesticks here, it has skyrocketed. Versus the low in 2020, we actually saw a low in 2020 at around 0.5%, which is dramatically different from what we see today at 3.75. Not too long ago, just a couple weeks ago, we were actually at 4.3 for this chart. And then in regards to the 30-year, you see a very similar story. If we pull up the 1-year candlesticks and we look over the last year or two and we go back to 2020, you can see a low at 1.1%. And then now you see the same story. A couple weeks ago, we hit a high. The high for this one was around 4.4 roughly percent over the last 30 years. And then you can see today it trades at 3.8. Now, what does this mean? If you're not familiar with what a bond is, it's extremely simple. You're buying a bond from the US government and they will pay you a set interest rate based on the price that you purchase it at. So for example, where we're at today at 3.75% on the 30-year, if you buy this bond, hold it for 30 years, every single month, every single year, they're going to send you checks and it's going to total to around 3.75% in interest per year. And then at the end of the 30 years, they'll pay you all your principal back, all your initial investment. Now, what you can do here is that we have different brokerages that track different types of funds. And if you look here, if we go to bonds, if we go to domestic, we go to government, and then we go to long-term, you can see that we have a couple different ones to choose from. One of the most popular ones of these is TLT, which is the 20 plus year bond treasury ETF. And you can see that so far it's had a rough year in 2022, and even the last 2 years has been pretty rough because bond prices have tanked and yields have skyrocketed as we saw over the last year or so for these type of ETFs. Now, you might be looking at this chart going down, you might be saying, okay, now's the time. Now's the time you want to be buying these companies. Now's the time you want to be buying these ETFs. But I have to say I wouldn't be so confident because if you look at the S&P 500, you can see that it's down as well. And I want to talk in this video why I think it's a better opportunity to be buying stocks rather than to be buying bonds in this opportunity. So for example, if we look at the year-to-date chart for the S&P, it's currently down 16.85%. If we look at TLT, it is down 30%. And that is the thing that is interesting here is that you might be looking at it, seeing it go further down, and you might be saying to yourself, wow, Jordan, you're wrong. It went down a lot more. It's likely to rebound, right? Well, I wouldn't be so sure. This is a study done many years ago. This is actually a chart that's a little bit outdated. It's actually written in 2011, but it still applies because this was over a long time period. Actually, this time period was almost a 50-year time period. It was 46 to be exact. What it was is it's showing you the differences, and it's titled The Fate of $100. It's if you did three types of investments, okay? One is treasury bills, which is similar to a bond, except it's just shorter duration. You constantly just get a couple percent back on your money, similar to what we're at right now at 3.75%. This is, I believe, the average during that time period was somewhere around like 4 or 5% over the course of that time period. So keep that in mind. Your $100 investment at the end from 1965 to 2011, over 46 years, traditionally an adult lifetime, your $100 would have become $1,300. Now, what if you invested in another popular investment that I think is non-productive and not even close to as good as a bond or a stock, which is gold? Your $100 investment would have become a $4,400 investment. And then finally, we get to stocks, which is what I'm interested in and what I put all my money in, which is $6,000 on your initial $100 investment. Over that 46-year period, you would have 60 extra money. So let's say in this example, you put $1,000 in. This would have been $60,000. What if you would have put $10,000 in? It would have been $600,000. You get the point. And that's what I'm trying to do here. Because when you look at my track record and you look at my month-over-month returns since joining the stock market, and I have documented all this throughout my YouTube channel, right now we currently sit in the $40,000 range. As of today's closing, we closed at $41,299 to be exact. And we did just close out my trade, by the way. I did want to mention I had a short position on ELF, and I did want to mention that. I'll show it in the next video. I did close that out today on the downturn. The stock finished down around 3% or so today, so I did want to briefly mention that. But if you look at the companies that I have, I invest in growing profitable stocks. And we can look at some of the names that I invest in, like a Salesforce. That's the largest holding in my growth portfolio. If we pull up ticker symbol CRM here, Salesforce, which by the way is reporting their earnings like now, so get ready, that's going to move the stock big time. But you can see over the last 10 years, it's compounded its earnings 27%. Or excuse me, its revenue 27%. It's compounded its earnings 28%. But it's not just fast-growing companies like this. If you go to my dividend growth portfolio, you can look at very defensive companies that are growing their revenue over time. What about a JP Morgan, which is tied for the number one position in my portfolio? Over the last 10 years, it has grown its revenue compounded 2.27%. What about the other holding that's tied for first place, which is WP Carey? They have grown their revenue at a compounded rate at 14.75%. And profits, like many of these companies, has grown alongside it. Now, the most important part of all of this is what you'll get paid as a dividend. Is because if you're really investing in treasuries, what you're really looking for is a hedge against the stock market and a consistent source of free cash flow. Now, the thing is that once you buy one of these treasury bonds, you're going to get a fixed rate. So say that you buy today at 3.75% over the next 30 years. Well, it's just that. That rate for 30 years, nothing more, nothing less. You're going to get that exact same bond payment every single day throughout the next 3 decades, and it's not going to move no matter what happens. However, what if you tried a different approach? What if you invested in companies that are growing their dividend over time? One of the core holdings in my dividend growth portfolio, which currently sits at a 5% target weighting, currently has a dividend payment that is $1.08 per quarter. Let's look at this on a quarterly basis. Now, Pepsi is an exceptional company. They have been growing their free cash flow at ridiculous rates for decades. Not for years, for decades. And if you look at this chart over time, it becomes extremely apparent how fast this growing cash flow gets. Because you can see it goes back to just pennies. And then every single year, it goes higher and higher and higher. And Pepsi has raised its dividend at least once a year, every year, for 50 years straight. And you can see how it becomes pretty apparent how this yield can dramatically increase over time as long as you're willing to hold your investment. Let's just look over the last 10 years, for example. Right now, it pays out $1.15 per quarter. If we go to just 10 short years ago, you can see that it was paying out 54 cents. So in that 10-year time period, period, it's over doubled its cash flow, and if you were holding a treasury bond, you would have received the exact same payment. In the meantime, while a company like Pepsi has doubled what it's paying you just for simply holding and owning the stock, and then more importantly, throughout that 10-year time period, the actual stock price has went up 160%. So in that 10-year time period, you would have constantly received checks every single quarter, every 90 days. You would have doubled your check amount over the next 10 years, and the actual principal investment, say that $100 investment you threw into Pepsi, would have increased 160% over the next 10 years. Now, this gives you an example, just a very basic level, of why investing into stocks is better than bonds. And I have to say, while it's easy to look at this performance for the bond market and say now's the time to buy, I'm not convinced. I think if you're wanting to buy a small part of your portfolio as a simple hedge in case the stock market goes down, that's fine. Because typically, if we look over the last 5 years here, for example, when do bonds rally? You see during 2020, during the big uproar here, when the crash during the COVID pandemic was happening, bonds were skyrocketing, which was great for people that had bond investments that helped protected them. Which leads me to why you should maybe consider having a small percentage as a hedge, but your overall position should be in stocks long term, in my opinion. It's not financial advice, do your own research, but that is what has been successful for me. That's what history tells us has been most successful, and I think that's what's going to lead to the best results going into 2022 into future years. Thank you guys so much for watching all the way to the end. Check out all my stuff down below in the description, including MooMoo, so get signed up with that if you haven't already. But thank you guys so much for watching. My name is Jordan, I'm a Millennial Investor, and I'll catch you guys next time.